I think the UK market's going to have a difficult year in 2016. There's a number of headwinds that we have to overcome. You know, US interest rates are going to be going up. You've got growth problems in emerging markets and China, and we've had a very strong economic period in the UK, and I think coming off those comparatives is going to make next year quite difficult for markets. Well, I still think that the companies with low levels of cyclicality in their earnings base, so that's businesses that are not sensitive to the rate of economic growth. So that would be consumer staples, so you know, soap, shampoo, and things like tobacco and pharmaceuticals, and maybe water and electricity utilities, those sort of things. I think where you've got that reliability in a difficult market, I think those things will trade quite well. Small and mid caps is always difficult because there's so many companies to choose from, and within that market it is all about individual stock picks. So I think as a whole I would think small and mid caps could continue to do reasonably well, even though the market outlook's quite difficult, but it is going to be crucially dependent on which companies that you pick. I think turning to income funds, I mean obviously as an income investor for many years now, I think income always is going to do better than other areas of the market. But if you think about an environment where interest rates are relatively low, even if they go up a bit, yields in the market are not especially high in general, that I think income investing will continue to be one that delivers attractive returns relative to other kinds of investment styles. You've got to be really careful if you're going to be contrarian about not investing in stuff that's at the beginning of its decline. I mean, the really big calls, I think, contrarian-wise, would be either exposure to emerging markets or exposure to resources, so that's oil and mining. Both of those areas have been terrible this year, but I don't really see conditions for that kind of contrarian investing to work that well next year. Possibly in oil, because you've got the wild card of the Middle East and the issues surrounding sort of the political instability there. But generally, those big contrarian calls still look very risky to us. Oh, the key issues, you know, where do you want to start? I mean, I think the biggest one is we're coming to the end of a period of unprecedented easy money, whether it's quantitative easing or ultra low interest rates, and I think coming away from that stimulus environment is going to be quite difficult and take some time. So I think that's a really big driver. I think the second one is that one of the major engines of economic growth in recent years have been the emerging markets and economies like China. And I think they've got significant challenges today, and I think those are a big headwind for global economic growth. So I think a combination of those two suggests to me that the next year or two we've got to go through a process of coming to terms with what those add up to for global growth and corporate profits particularly, which is what should drive markets.